Most people think a credit card is just a piece of plastic or a digital token on your phone that lets you buy things now and pay for them later. You think you're the customer, but in the world of high finance, you aren't the customer, you're the product. Every time you tap that card, a silent, invisible war breaks out between 5 different billion-dollar entities. In the 3 seconds it takes for that approved message to pop up, a complex shell game has just moved money from the merchant's pocket, through a digital gauntlet, and into the hands of the world's most powerful banks. But here's the kicker. If you aren't playing the game correctly in 2026, you are effectively paying a shadow tax on every single thing you buy.
From your morning oat milk latte to your car insurance. Today I'm pulling back the curtain on the credit card system to show you exactly how the plumbing works, why cash is now a losing strategy, and how the top 1% of earners are using AI-driven systems to make the banks pay them. To beat the system, you have to know the players. Let's break down the 4-party model, which ironically actually has 5 players. 1. The cardholder. You want convenience and points. 2. The merchant. The coffee shop or Amazon. They just want your money, but they have to pay a toll to get it. 3. The acquiring bank. This is the merchant's bank. They provide the hardware, the card reader, and make sure the merchant gets paid. 4. The issuer, the big boss. This is your bank. Chase, Amex, Capital One. They take the risk of lending you money. 5. The network, the freeway, Visa and Mastercard. They don't actually issue cards or lend money. They are just the digital freeway that the data travels on. When you spend $100, the merchant doesn't get $100. They usually get around $97.30. Where did that $2.70 go? It's carved up like a Thanksgiving turkey. The issuer takes the biggest slice, the interchange fee. The network takes a tiny switch fee. The acquiring bank takes a markup. Now you might say, why should I care? The merchant pays that, not me. Because the merchant isn't a charity. They've already baked that 3% cost into the price of your coffee. This is the invisible tax. If you pay with cash, you're paying the credit card price without getting the credit card rewards. You are literally subsidizing my next business class flight to Tokyo. Why do banks want you to use cards so badly that they give you free money back? It's not because they're nice. It's because of a concept called payment friction. In the 1970s, paying for things was annoying. You had to write a check or count physical bills. That friction made your brain realize money was leaving your possession. But as we moved to swiping, then dipping, and now Face ID tapping, the friction has vanished. Studies show that people spend up to 80% more when using a card versus cash. When you tap your phone, your brain doesn't register loss. It registers gain. You got the item, but you didn't feel the cash leave your wallet. The banks aren't just earning 3% on the transaction. They're earning 100% of the interest on the extra 80% you spent because you didn't feel the pinch of the purchase. But wait, the system just changed lately. Especially in 2026, we've entered the era of predictive finance. Visa and Mastercard have integrated Agentic AI into their networks. It's no longer just about processing a payment. The system now analyzes your spending in real time to offer dynamic merchant credits. Have you noticed your banking app pinging you with a 10% off at Starbucks notification exactly when you're walking past one? That's the system using your location data and spending history to ensure you use their card over a competitor's. They are moving from passive rewards to active manipulation. The banks are now competing for your top of wallet status. They know that if they can get you to use their card for a small 10% discount today, they can keep you in their ecosystem for your next mortgage or car loan. So how do you win a rigged game? You play with their money, not yours. Here is the 2026 Pro strategy. Step 1. The multiplier. You never ever use a 1.5% flat card for everything. You need a card that offers 4x or 5x on your biggest fixed variable expenses, usually groceries and dining. Step 2. In 2026, rent is still most people's biggest expense. If you aren't using a service like Built to earn points on rent without fees, you're leaving thousands of dollars on the table. Step 3. AI automation. Use an app that automatically switches your default card in your digital wallet based on where you are standing. If you're at a gas station, the AI should trigger your 5% gas card. But the most important rule, the statement balance rule. If you carry a balance and pay even $1 of interest, the banks have won. The rewards are the bait. The 29.99% APR is the hook. You use the bait, but you never bite the hook. The credit card system is a transfer of wealth from the uninformed to the informed. It's a system where the person paying cash at the grocery store is helping pay for the person in the front of the plane. It isn't fair, but it is the reality of our financial infrastructure. Once you understand the plumbing, you can stop being the product and start being the player. If you want to see my specific top 3 cards for 2026 inches breakdown, I've put together a PDF that ranks them by real-world value, not just the fluff points. You can grab that at the link in the description. And if this video helped you understand where that 3% fee actually goes, hit the like button and subscribe. It's the only way to keep the algorithm in our favor. I'll see you in the next one.